Hello and welcome to the Tax Roundup for May, and it's budget month. I know you're all excited. If you're not already receiving our email updates, just go onto the Knowledge Shop website and click on resubscribe so you can get a copy of our advisor edition of the budget update the morning after. Big month this month. We're looking at guidance released from the ATO on lump sum payments to health practitioners. There's a new case also that's come out that potentially extends the rollover relief for marriage breakdown. In rulings this month, the ATO is looking at interest on bank accounts. And in legislation, some new legislation that's come through as part of this innovation scheme from the government, looking at a potential extension of the similar business test and also self-assessment of effective life. But first up, across to Bradley Beer for his tip of the month from BMT Tax Depreciation. Across to you, Brad.
Depreciation and renovations. A lot of your clients are buying investment properties and renovating. They've watched renovating on TV and it's all very exciting. The tax treatment's very important. And look, the main thing is make sure the depreciation schedule's in place before they rip it apart. The scrapping value of the items is something that means quite a bit of cash to the investors, and they often call us afterwards and say, I've done a renovation, can we do a depreciation schedule now? Important to do it first. We adjust it afterwards so they can take advantage of those things and get those maximum deductions.
Now across to Ray on that guidance from the ATO on lump sum payments to healthcare practitioners.
The ATO have provided some guidance in relation to lump sum payments made to those who work in the healthcare industry. It's quite common nowadays for those who might be working at a health centre or healthcare centre to receive a lump sum payment, which the taxpayers have been saying is in relation to possibly a non-compete clause or agreeing to provide goodwill to the health practitioner when they move their practice there or when they possibly start working there or agree to continue there. They have been treating those payments on capital account, and after application of the general CGT discount and the small business CGT concessions have ended up possibly with a low or possibly nil taxable capital gain. Now the ATO have come out with some guidance saying in their view that is ordinary income assessable on revenue account. The payment is directly linked, very closely linked, to the earning of the income by that healthcare practitioner in the performance of their ordinary services, and therefore that payment is also assessed as ordinary income. So a very different outcome in the ATO's view from that which has been taken by some taxpayers. So it would be important to look at any clients out there who may possibly have gotten these payments, not only this year but in the last 2 or 3 years. How have they been treated, and would the taxpayer's view be consistent with the ATO's view?
Michael is now going to take you through that really interesting case looking at the potential extension of rollover relief in marriage breakdowns.
Now let's take a look at the Sandini case, which went before the federal court recently. This was a case that dealt with a scenario where there was a marriage breakdown scenario, and the family court made an order that some listed shares were to be transferred from an existing trust into the hands of the ex-wife. Now, prior to that occurring, the ex-wife actually said that she'd prefer those shares to be transferred into her own family trust. So she made a direction that the shares be transferred from existing trust into her own family trust. The CGT event was triggered on the transfer of those shares, and the existing trust basically took the view that there was no capital gain or loss to report in its tax return because of the marriage breakdown rollover relief. So we then had the situation where the Commissioner said, well, hang on, that marriage breakdown rollover relief can apply when assets are transferred from one spouse to another spouse or former spouse. It can also apply where assets are transferred from a company or trust, but only where the assets are transferred to one of the individuals who was a party to the marriage or the relationship that is broken down. The Commissioner said, well, in this case, the assets went from one trust to another trust, and that wouldn't qualify for the rollover. So the key issue in this case was whether the transfer at the direction of the ex-wife would qualify for this rollover relief. Now the court started off by saying once the family court had made its order to transfer the shares, that basically caused the ex-wife to become the beneficial owner of those shares. So even though she never became the legal owner of the shares, she was the beneficial owner. And she then requested for those shares to be transferred into her family trust. So from a CGT point of view, the court was basically saying that even though the shares went from first trust to the ex-wife's family trust, It was as if they had been transferred to her personally and then been transferred into this family trust. So in that case, the court held that that transaction could actually qualify for the marriage breakdown rollover relief. Now, what wasn't really covered in the case was, well, what happened next? Well, if it was treated as if shares had been transferred from the first trust to the ex-wife and then into her family trust, that would deal with the CGT issue from the first trust's point of view, and that's where the dispute arose. But you would then have to separately consider the second CGT event, which presumably would have occurred when Ms. Ellison, the ex-wife, requested the shares be transferred into her family trust. The case didn't really get into that sort of detail, but what it shows is that having assets transferred at the direction of a party could potentially be treated as a two-step process from a CGT point of view. Now, our understanding is the Commissioner is looking to appeal the decision, so we'll wait and see where this ends up. But certainly at the moment, it does potentially open up some scope for a little bit more flexibility in the way that divorce and marriage breakdown settlements are structured, where people want assets to end up in the hands of a trust or another company, for example. Previously, we've always thought of the rules only applying where assets are transferred to one of the individuals, one of the parties to the marriage or the relationship. This opens up a little bit more flexibility potentially to have assets go into another vehicle where we can still disregard the initial transfer, but we just need to remember we can't forget that there might actually be a second event that needs to be taken into account. The issue is that it's an event that will be taxed in the hands of another party. So we're looking at a difference in terms of who actually bears the tax liability in that case. So we'll certainly keep an eye out for where this case goes in future, but certainly something worth taking into account when helping clients through marriage or relationship breakdown scenarios, because this could provide a little bit more flexibility in the way those arrangements are structured.
And from the ATO and rulings and determinations this month, we're looking at the interest on bank accounts across Array.
The ATO have released guidance in relation to accessibility of interest on bank accounts. TD 2017-11 covers off some topics that have been addressed in other guidance offered by the ATO, but this gives a little bit more formality and structure to it. When income is held in a joint bank account, the interest on that is generally held to be accessible to both of the owners in that account. Unless there is something specific saying beneficial ownership is different to the joint ownership, then it will be determined to be accessible on a 50-50 basis. If there is some reason that something might be different to that, for example, one person puts in an awful lot of income into that account and the other one doesn't, or one person has drawn out a lot of funds in that account, that could impact the amount of interest that will be accessible to each of those holders on the account. Otherwise, if you don't have evidence to support that, the tax office's view would be that it is 50-50. Now, when it comes to children's bank accounts, the ATO look not only at the money going into that account, but who has actually got access to use those funds, if anyone. So, for example, a parent might set up an account for their child. Money might go in for school events, birthdays, other things that other people might want to put into that account. If the money in that account is used by the parent for the child, for example, to fund school trips, then the ATO's view would be that the parent will be accessible on the interest income from that account because the parent is the one using the funds, even though they might be listed as trustee for the child on the account. However, if the money just goes into that account for the minor child and is not touched, then the income from that money will be viewed as interest income accessible to the child, which can be a good answer until they get to the stage that they're now facing penalty rates for minors. So just one thing to think about, who exactly is accessible on that interest income.
And finally, in legislation, across to Michael, looking at the similar business test and also self-assessment of effective life on intangible assets. Across to you, Mike.
Now we're seeing another aspect of the government's National Innovation and Science Agenda items getting closer to fruition with the introduction to Parliament of a bill which contains two key elements. The first element is a relaxation of the company loss recoupment tests. At the moment, if a company wants to recoup some prior year losses or capital losses or claim bad debt deductions, for example, it normally needs to pass either a continuity of ownership test, or failing that, it needs to pass a same business test. Now, that same business test is quite a strict test with some very strict conditions in it. It's also interpreted very strictly by the ATO. The government is introducing a watered down or relaxed version of that test, referred to as a similar business test. And that's one of the elements of this bill. Basically, what the government wants to do is improve access to prior year losses and things like bad debt deductions for companies where there has been a change of ownership, so that we're not dealing with quite the strict rules that we deal with at the moment. Now, these rules are intended to apply from 1 July 15 once they have been introduced, and would provide a little bit more flexibility for companies to utilise losses, even though there may have been a change in ownership. Now, when considering whether a business is similar, so whether a company is carrying on a similar business to what it did when losses were incurred, the legislation says that there are certain factors that you need to take into account. And this is not an exhaustive list, but these things at the very least need to be taken into account. Types of things you would need to consider are the assets that were used in the former business and the current business, the activities and operations that were used to generate income, both previously and now. The identity of the business needs to be considered. And we also need to consider whether the current business is a development of the former business. So there are some things that we will need to consider when working through the test at a practical level. As I say, this is not an exhaustive list, so there may well be other factors that become quite relevant in determining whether a business now is similar to a business that was carried on when losses were incurred in a prior year, for example. So certainly we should see a little bit better access to company losses for companies where there's been a change of ownership that has taken place. The other aspect of the bill, which should be quite interesting for a number of business taxpayers, is the ability to self-assess the effective life of certain intangible depreciating assets. So some examples of that might be copyright, could be rights held in relation to patents, registered designs, it could be in-house software as well. At the moment, you cannot self-assess the effective life of those assets, and you are stuck with using the effective life that is set out in the legislation. Under these rules, where assets, intangible assets, start to be held on or after 1 July 2016, the business will be able to make their own determination as to the effective life of those assets. There will also be scope to reassess effective life at various points in time in the future. So much like businesses can do with many tangible depreciating assets, the option to come up with your own effective life will be available to these intangible assets as well. Now, it is again up to the business to be able to demonstrate that that is an appropriate effective life. You would be expected to give some thought to factors that are relevant in determining what an effective life might be, and documenting that decision-making process and the rationale for that effective life would become important in terms of defending the decision that's been made, maybe at a later point in time. So two developments they're good for business. We see maybe relaxation of the company loss rules, ability to be a little bit more flexible in terms of effective life of certain assets. The bill is only a bill before Parliament, not law just yet, but hopefully in the coming months we'll see that pass into law and give businesses a little bit more scope and flexibility in the way that they manage their tax affairs.
And that's the tax roundup for this month. It's getting busier than ever in the May period. Just remember, if you're a member of Knowledge Shop, you have the help desk, you have the resources for the Knowledge Bank, you have updates when you need them. But if you're not a member, then give Julie a call on 1800 800 232 and she'll look after you. Speak to you soon.